What are Treasury securities in monetary policy? Imagine the government needs money to build roads, schools, and hospitals. It borrows this money by issuing Treasury securities. These are basically IOUs from the government to investors. The main types are Treasury bills, notes, bonds, and Treasury Inflation-Protected Securities. Treasury bills are short-term, usually up to 1 year. Treasury notes last from 2 to 10 years. Treasury bonds are long-term, often up to 30 years. Treasury Inflation-Protected Securities, or TIPS, are special because they adjust with inflation, protecting investors from rising prices. The Federal Reserve, which is the central bank of the United States, uses Treasury securities as tools to manage the economy. When the Fed wants to stimulate growth or lower interest rates, it buys Treasury securities from banks and investors. This process is called open market operations. Buying these securities puts more money into the banking system, making loans cheaper and encouraging spending. When the economy needs to slow down or inflation is too high, the Fed sells Treasury securities. This pulls money out of circulation, raises interest rates, and helps control inflation. Interest rates on Treasury securities, called yields, are important signals. When inflation expectations rise, investors want higher yields to compensate for losing purchasing power. The Fed watches these yields closely because they influence other interest rates like mortgage rates and business loans. If yields go up, borrowing becomes more expensive, which can slow down economic activity. If yields go down, borrowing is cheaper, and the economy can grow faster. TIPS are especially useful because their principal value adjusts with the Consumer Price Index, which measures inflation. When inflation rises, the principal of TIPS increases, and so do the interest payments. This makes TIPS a good indicator of what investors expect inflation to be in the future. The Fed keeps an eye on these expectations to decide whether to raise or lower interest rates. When the Fed buys Treasury securities, it increases its assets and expands its balance sheet. This means banks have more reserves, which can lead to lower interest rates and more lending. Selling Treasury securities shrinks the balance sheet, reduces reserves, and can make borrowing more expensive, helping to slow down the economy. In short, Treasury securities are a key part of how the Federal Reserve influences the economy. By buying and selling these securities, the Fed can control how much money is circulating, influence interest rates, and keep inflation in check. They are essential tools for maintaining a stable and healthy economy.